Hey, and we are live. Yeah, it's pretty rude, a rude hour of the day for Benny in Wisconsin at 1 a.m. But we're delighted to have Craig Coben up early in London at 7 to join us on the show. Craig used to be global head of equity capital markets of Bank of America Merrill Lynch, old friend of mine. He's been on my pod before. He also writes regularly for the FT's Alphaville column and has been following the SpaceX story very closely, as well as being an occasional tormentor of Michael Saylor, which is one of Benny's habits as well. Anyway, we are at 4 p.m. Melbourne, 7 a.m. London, and 2 a.m. Eastern time. And I'm guessing we're going to get a price for SpaceX of sorts in 7 hours' time. Craig, how are we feeling about the countdown?
How are we feeling? I'm feeling fine. I think it's going to be one of the most anticipated moments ever in the equity capital markets. I don't know what time the stock is actually going to open. Bear in mind, it takes a few hours for the market makers to match orders on the buy and sell side. So we'll have to see exactly when this opens. It may not open until noon or even 1 p.m.
What's the latest?
New York time.
What's the latest you ever saw? I think it was well after lunch. The latest I ever saw.
Yeah, I think this one's going to go probably closer to 1 p.m. Is probably my best guess. I just hope that the systems are in place at NASDAQ to be able to handle it, unlike what happened 14 years ago on the IPO of Facebook when the systems were overwhelmed and everything started to collapse.
I remember that one quite well.
Well, I also remember one theme of Facebook was retail getting an awful lot of stock, which appears to be the theme this time. Craig and I were just chatting offline while he was caffeinating, and we really don't know how to prepare ourselves for 30% of stock at least on such a large deal going into retail hands off the bat. I'll have a look at, and actually maybe we'll start it with this. So just before we came online, there was clearly some evidence of activity by Korean retail, as there was a little spike on the hourly on Hyperliquid. I'm currently spotting slightly below there now. I've got this live on another screen. It's showing 180 spot 59 versus the 135 IPO price. But to be honest, that grey market, which should not always be trusted, has been pretty much giving back or drifting off ever since they listed it about 10 days ago. Craig, your thoughts on grey markets? Should we trust them?
No. In my experience, the gray markets actually don't provide fantastic price discovery. Hyperliquid could be the exception that proves the rule. But I've done a lot of IPOs, and you'll recall in IPOs, there used to be some gray markets that would operate, and we'd all would look at them obsessively for clues on how the first day would go. And there was almost no correlation between the performance in those gray markets and the actual first day trading.
Well, we've also got prediction markets at play here. So I bothered to translate the market cap estimates at closing today into dollar share prices in yellow in the middle there, and so where the Hyperliquid gray market is trading right now is bang in the middle of that $2 to $2.5 trillion spread on the prediction markets, or specifically this one, poly market.
You can drive a truck through those spreads, Rupert. Jesus.
Yeah, but these are digital odds, right? They've just got.
Where did you get this from? I'd be very interested. You'll have to send me later with a screen, because this is a fascinating screen to see.
It's just from Polymarket. I think there's similar odds on Kalshi as well.
Okay.
Everyone's got to have a punt on it.
And yeah, actually, look, I mean, we live in an era of prediction markets and everybody, gamifying and betting on outcomes. And it's really putting to the test the wisdom of the crowds theory. which I'm not sure is as empirically robust as has been represented in the past. Look, they're fun to look at. I think there's so many unknowns here that it's almost I mean, it is impossible to predict, but I don't know how indicative those. It'll be a great test case of these prediction markets and gray markets.
Yeah, I'm not sure. I think it's an interesting guide. I wonder if the market maker at Morgan Stanley that's going to be opening the stock is going to have half an eye on how these hyperliquid markets are moving, or will he just look at his bids and his asks? It's an interesting process. That why don't you describe it for people that don't understand the role of the market maker in opening a stock? We've already talked about how long it might take him, but the actual mechanic of how he matches up the order book and corrals people into some sort of shape of discipline.
Well, I didn't work on the trading side, Rupert, so I'm going to have to. I'm speaking at one remove, but at the open, there's going to be a whole series of orders, both buying and selling, and they have to sort of find a clearing level. Like any market maker, you have to find a clearing level for those orders. The problem is that it's not against the backdrop of a continuous market. You're kind of starting from sort of a standstill, and you actually don't know where to even begin. Normally, you would begin off the closing price, but you don't have a closing price here. You have a 135 price, which may or may not accord with where the market really is. It's a little bit like we sometimes see this as well when the stock has to be suspended due to a material announcement, such as a takeover bid or something like that you see in European markets. And it takes a while for the market maker to be able to find where the buyers and sellers are meeting.
And this is interesting because there wasn't a range. There has been absolutely zero price discovery through the course of the roadshow in the past week. And so you don't know if Fidelity had cares at 145 or 125. To be honest, I think the pricing's somewhat arbitrary. The pricing was done before the start by Elon Musk. And so, and really with this valuation, price discovery was kind of a bit of a nonsense anyway.
But don't you think though that, I mean, they did a lot of testing the waters. They had a lot of reverse inquiry from people. I find it hard to believe they didn't do a fair amount of price discovery. It was just done before the roadshow. Now you can say, well, maybe it's stale because the market has sold off since then. Fair enough, but it's a little bit like, a lot of these deals we do in Europe, where you do all this pilot fishing and early look meetings, and so by the time the roadshow comes along, you kind of know where people are, and it's an anticlimax.
Well, isn't 1.75 trillion market cap the number that Elon spouted out 6 weeks ago, and just so happened that price discovery zeroed directly in on that number?
But that's often the case, though. I mean, you've worked on a lot of deals, and a lot of times the founders tell you what outcome they have, and then you're sort of, as a banker, you're kind of scrambling to find a way to make that make sense. This is maybe a more extreme version. I actually, I don't, a lot of people have talked about the fact that they fixed the price before the roadshow. I don't think it's that meaningful. If that's where this Elon Musk wanted this to IPO, then it was always going to IPO there. And they have probably been soft marketing that number, socializing that number for quite some time with investors, well before the start of the formal roadshow.
Yeah.
And so when we think about this deal, and like you think about 556 million, the green shoe, Rupert and I were laughing. The green shoe is the 10th largest IPO of all time by itself. I mean, so I was talking to some guys, the brokers were telling me on Bloomberg today, it's like 6-7 times over. I heard some guys tell me at 3 p.m. they were calling around saying, hey, do you want stock? Somebody told me they were cutting retail. I mean, you guys were both running deals. How much information are you really giving out as the deal captain? Are you giving information out from a marketing standpoint, or are you giving information out? Like, I'm always curious about like how that information flows out, and why do you give what you give?
So you give out information. First of all, the information you give out must be true. Okay.
Okay.
Even in today's much more deregulated system, it must be true. And I think, and so I think I would, whatever comes from the syndicate desk, I would take, I would assume is true. The problem is I don't know what's coming out of the syndicate desk and what's being leaked to the media. And so a lot of these numbers that are being thrown around levels of coverage are anyone's guess. The second is that just because you're being given a piece of information doesn't mean it's actually meaningful. To me, whether a transaction is 4 times covered, 5 times covered, 10 times covered, 20 times covered, that doesn't mean anything without actually knowing who the coverage is and what the likely behavior is. We've all seen deals that have been 20 or 30 times covered, which have traded poorly. And we've all seen deals that have been 2 or 3 times covered, which have actually held up fairly well. So, you know, what I would say, and not only that, I think that there's just so many sources of information around this deal. Like let's take retail. I mean, there is going to be a big retail allocation. Musk has signaled it. People will be getting filled or almost filled, but is that just at the big brokers? What about the smaller brokers like Robinhood? Are they being treated differently? We just don't have that information. We also don't really have information about who is in the book. I mean, most deals you tend to think of, you know, the hedge funds, the large, long, short hedge funds will put in 10% orders, knowing they're going to be pulled back, knowing they're going to be allocated, you know, much less, say 20% or 10% of their order. But is somebody really going to be putting in an order for $8 billion on this IPO? I think that's, even for the largest hedge funds, I think that's a bridge term. I mean, they could do 4 billion, 5 billion. A couple could do that size, but you know, it's just not credible for one of these hedge funds to be putting in an 8 billion order. So everything's different about this deal, and that's what makes it very difficult, in my view, to handicap. We've never seen this much retail of a deal of this size. Actually, I did a deal once which had almost 50% retail by necessity. That was in Europe. It was the EADS IPO, the old Airbus IPO. It didn't trade very well. And we also don't know. I mean, I think Rupert has written in his blog about performative orders. I would say there could be performative orders as well as performative aftermarket orders by some of the people who are in this deal, who are sitting on 10 times, 20 times gains, and who have been asked perhaps, or who feel an obligation to support this transaction in the aftermarket because they're sitting on just such windfall gains. So it's all, you know, we'll be a lot smarter in a few hours. Right now, it's, you know, I've been asked by a lot of people, where do I think it's going to close? And the short answer is, I don't know. We've never seen a deal quite like this. And so
yeah, I agree with you. I would love to take us to something that we touched on, Craig, back in the days, in those cozy days pre-war, when we were talking about how it was outrageous that the NASDAQ 100 index committee was going to give a fast track access and you know, free float boost. But we got the news last week that the S&P was holding its guns. And I mean, chapeau to them. But that leaves a big hole in what I have been terming the warehouse trade, where a lot of the confidence around that mythical $8 billion hedge fund order, if it were to emerge, would be that you could turn it over to the index army when that army turned up. Now, the vast majority of the both pure passive and the closet benchmark money is benchmarked to the S&P indices. Yep, the Russell indices and the Nasdaq have broken ranks on that front. But really, by comparison, those numbers are peanuts compared to the S&P benchmark money. So I'm just wondering if the whole warehouse trade is a little bit less reliable.
Look, I've seen a lot of different estimates around index buying, and in Bloomberg reported yesterday that Entropic, which is a firm that specializes in this stuff, was estimating that I think 30% of the float would be coming in, would be buying in the first couple of weeks. So I think different hedge funds I've spoken to have different estimates from yours and from other people. I think a lot of people are trying to figure out the quantum of index buying. I'm not an expert. I mean, this is, there are a lot of indices, and there are a lot of people, there are a lot of indices out there, and not to mention there are a lot of vehicles out there that are being developed to track SpaceX as well. On a leverage basis. So I think all of these estimates probably have a sizable margin of error because it's just very difficult to understand. I mean, the index providers are opaque to a certain degree, and they are for a reason. I agree with you. I think the S&P committee decision, is potentially quite consequential because SpaceX may not even qualify after a year for the S&P 500 if they stick to their requirements around profitability. And it's interesting.
Also, the S&P 500 already has a problem with valuation, right? And if they were going to stick, this is over half of the S&P 500 by market cap is weighted towards stocks trading at north of 10 times sales, right? And to add SpaceX and then OpenAI and Anthropic on top of the mix, it was just going to compound that problem worse. So I think they've done a lot to protect the passive investor here.
Yeah, and also I think one of the things that's going to be interesting is when the 3 AI Migos all list. By the way, that's my expression, so you guys are not allowed to use that now. I'm trademarking out 3 AI Migos. When they all list, it's going to be interesting to see actually what happens with these indices, because the Magnificent Seven have dominated the S&P 500, and to some degree, some of them have rallied precisely because they're geared towards AI, or even because they are proxies for these companies. Microsoft, would Microsoft have performed much worse this year if it hadn't held the substantial stake it holds in OpenAI? In much the same way that Yahoo ramped up in the run-up to the Alibaba IPO.
Yeah.
Then when Alibaba went public, nobody cared about Yahoo anymore. It's not going to be nearly that extreme with Microsoft, but to some degree, Microsoft has been the proxy for OpenAI, and and Amazon and Google have been in Anthropic and so forth, and Google is in SpaceX. So
Google's got a healthy 5.5–6% of SpaceX, and one wonders just about some of those deals on those NeoCloud deals that were announced last week. Ben's been doing a lot of work on this.
Yeah, I mean, basically, SpaceX needed some EBITDA, and their Grok is just terrible, so they have no market share in Grok, and they're like, hey, we'll get a quick 26 billion of EBITDA, but as Rupert and I have talked about, I don't know if you put 100 times EBITDA on a REIT. You know what I mean?
Yeah, I mean, I'll leave the fundamental analysis to you, Betty. I mean, I looked at the prospectus, and look, I think this is, as I think Rupert has said before, I think a lot of the valuation is based on whether you believe that Elon Musk can deliver on the future. Here, it's not really going to be a possibility.
I got to love a big shout out to the picture editors for FT Alphaville. And your title on your piece the other day.
they're great. I mean, so by the way, I have no say in the headlines. Look, I don't decide the headlines. I don't decide the stand first. I don't decide the picture. But the FT Alphaville editors are superb. I mean, they're almost, I asked them if they did an internship at the New York Post or, during the period of time when Anthony Weiner was, under investigation. And anyone who looked at the New York Post during that period of time will know that it was almost Shakespearean just how good their headlines were. And I really feel that the Alphaville editors are in a class of themselves. The way they find these photos and some of the stuff is hilarious. You didn't have it there, but there was one article I wrote on MicroStrategy on strategy, and the editor had the title of, what will we do with a shrunken sailor? And I don't know how he came up with that. It was just so good. And then all the comments below were just not about my article. Nobody cared what I had to write. It was just about, I think it was the stand first in the article. So, but look, it's great to have a little bit of fun around the capital markets because, it is interesting, it is intellectually interesting, but it's also fun, and it always confounds our expectations. I think one of the reasons, at least why I find the capital markets interesting, is whatever I expect, things tend to do the opposite, and it instills in you, no matter how long you've been, no matter how much of an expert you think you are, it instills in you a modesty. And I think coming up to SpaceX, I find it, whatever we think of the company, whatever we think of the equity story, whatever we think of Elon Musk, I find it a fascinating real world experiment.
Yeah, I mean they're breaking, just every norm with this one, and he's done the unexpected so many times. So, listen, do I have any skin in the game? Absolutely not. Beyond jokingly suggesting that it might get pulled yesterday to torrents of hate mail on Twitter, but that was just for the lulz, as it were.
You're a troll. You're an online troll, Rupert.
But I look at this. I mean, I've got probably about sort of 60 bids in my closest to the pin competition amongst my readers I've got running on Discord, and it's a pretty decent spread. There's someone at 0, but he will be forgiven. But basically, the spread is going from marginally below IPO price to close the day today to, I think the most aggressive bid in there is 200 for the closest to the pin, $200 a share. So everyone's got a nose and everyone's got an opinion right now.
I've heard everything. I mean, I spoke to a fairly senior hedge fund manager yesterday who's very experienced in new issues. He thinks that it'll trade pretty heavy today. He thinks it could go down 15-20% because so much is going to retail and it's such a large deal. And paradoxically, what he thought was that it could then kind of come back on the back of the index buying, the shadow index buying. So whereas a lot of people are expecting a pop and then it kind of deflates, he was expecting actually it trades heavy and then it comes back. And that's what makes a market. His explanation sounded absolutely rational and convincing to me, but his guess is as good as anyone's. If I were to say with the consensus view based on the people I've been speaking to, it's not far off what you're hearing. People are telling me they think it's up 10 to 15% on the first day. Big deals tend not to pop. Obviously, nobody's seen a deal of this.
I just to say, I think I had 146.50. I started it at.
Okay, well, you are, Rupert, you're kind of in consensus, and I always thought for you, conventional wisdom was all convention and no wisdom, but you're kind of in the middle.
I had to start them somewhere.
Yeah, that's kind of almost a consensus view. But the expectation is that it won't pop because it's just such a big deal. The expectation is also that the stabilization manager, Morgan Stanley, will defend this deal and not let it break issue price. They've got a big green shoe. They got a 15% green shoe, which, as Benny said, would rank in the top 10 of all IPOs ever. But we all know that if there's a fire hose of selling, you can blow through that
No.
green shoe. I think one of the interesting questions here is what the tactics of the stabilization manager will be if it comes under pressure. Do you defend it up front, or do you let it drop and then try to buy at the end to bring it up to issue price at the end, so that the headlines aren't that the deal closed down, but it's better that it closes flat than it closes down? I'd be interested in your perspective, Mr. Squirrel.
Yeah, I've traded a lot of green shoes in my past, and you know, not as the actual presser of the button, but as formulating a strategy. I would have thought that this is something that they can't allow to get out of control. So I would have thought they'd be pretty aggressive at 135 if that number was in threat. I also think that it's almost certain that they will have to disgorge any syndicate profits of shares bought below 135. So I don't think there's any incentive on that side. I'm sure that element of the underwriting agreement has been tied up by Mr. Musk. Just an explainer.
Is that right? Is that right? Because I thought in the U.S. you can't. I know in Europe and Asia we would always have to give back the stabilization profits, or a portion of them.
Not always. Not always.
Well, not always, but often. That's true. Not always, but often. But I thought in the U.S. I thought that you can't. I thought that was either illegal or difficult to do. You know, bear in mind, when I wrote about this a couple of years ago, when the Birkenstock IPO happened, and I know this because I spoke to people, the banks made more money off the stabilization than they did off of the
deal.
off of the deal, because you know they were the I think it was Goldman Sachs was a stabilization manager, and it was buying 10-15% below the IPO price. That being said, whatever the rules are, okay, there's no way in the world that Morgan Stanley is going to leg over Elon Musk by letting this go down and then buying it in to make a stabilization profit. There's no way in the world. I mean, the reputational aspect of this is paramount. It's greater than actually the profits on this deal, which actually are not that large for the banks. But the question is,
well, on a spread basis, in an absolute number, it's still pretty big.
I don't agree with that. Okay, because my understanding is the 5 joint book running managers are at 10% each, so they're making call it $56-57 million. Then you have to take into account the capital that they've had to commit to the deal. Then you have to take into account that they've had to do some sort of grok subscription and everything else. They'll make profit, but this is not the. I've done bigger windfalls in my career even before all of that. And so have you.
They've also all had to redecorate their lobbies in Midtown over the past week.
So I mean, but be that as it may, I look, Morgan Stanley as stabilization manager has a huge amount at stake reputationally. They took a lot of grief at the time of the Facebook IPO, fairly or unfairly, who knows, and so I think they will try to do what they think is the right thing by the deal. But the question is, if there's a lot of selling, do you kind of let it go down a little bit and then try to bring it up at the end, or do you defend it? I would agree with you. I think at first they're going to defend it pretty hard at 135. If that becomes unsustainable, then, you know, instead of blowing the whole shoe in the first hour or two, you kind of let it go and then you bring it back. Yeah. So I would expect, I think it would be, I don't know what the military doctrine is. You guys are much more erudite than I am, and probably can tell me, boy, you defend and then you kind of, you know, withdraw,
you retreat,
and then you kind of come back.
Retreat.
No, I mean, I've seen it a million times. I participated in so many deals, and you know, like CoreWeave, right? Like the CoreWeave deal couldn't get all across the line until Nvidia comes in and gets it there, and they flushed it. And then they literally let the option market open, and then they ripped that thing on anybody who was shorted because it was so negative. So if the deal's actually negative and they're not actually telling people that, they know it. They know that you guys know. You guys knew when you were sitting on a bad book. So you would tell them, hey, let them flush. Let all these guys come in, see if they want to short it, and then we'll rip it on them. You know what I mean? Like I've seen it a million times.
I
Yeah.
think that is a phenomenon since both Craig and I left the industry, which is this the modern day option market being open on IPOs so soon really changes the early day dynamic. And you've also got, and we alluded to this earlier, you've got all of these twice levered ETFs ready to roll today, right? These things are ready to go straight away, and you know, so they have to be factored into the the early days demand dynamic.
Is the option are the options going to be tradable on the today? I thought they don't trade for 3 days.
Not the day off, not the day off, but they're going to be.
I reckon they'll be. I reckon they'll be up by Monday, Tuesday. At the latest.
Well, you guys are like the Hannibal, okay, of military strategy. Now you can debate which Hannibal I'm talking about, but when it comes to stabilization, I think. But on a serious note, I think you have to be quite tactical in and I think they're going to be thinking through these decisions if it comes under pressure. And the other question that we don't have visibility is who's putting in the orders to take this up in the aftermarket. There will clearly be people who will put in orders. You could say performatively or whatever, but there will clearly be people. If it generates momentum, then other people will pile in. And I don't know as well how much people are being cut back on their institutional allocations. And even if they're cut back, do they really want more? Or have they just put in orders because the ECM players have to put in an order. Even if they don't like the deal, they've got to put in an order. So, I don't know how it's all going to play out. I can see, like the hedge fund guy I spoke to, I can see where he's coming from and thinking that it could start heavy and actually come roaring back.
Well, I think, all this talk of shoe, I mean, I think a huge part of the retail bid is really there for the long haul, right? I don't think that there is reasonable by sensible retail investors a reasonable expectation of massive day one returns. And it didn't happen till quite late. It does look as though Tesla has traded heavy in the last couple of weeks, and there's some kind of migration of those fanboys into the SpaceX register, and those guys aren't selling. But we have not dealt with a retail bid that is 2x the green shoe. I mean, I've literally never seen that. There used to be in Hong Kong IPOs, there used to be a retail clawback, which could sometimes make your retail allocation 15% greater than your green shoe. And this is basically, it was a Hong Kong exchange rule. If a deal was more than 100 times covered, then the retail allocation would go from 10% to 20%. And that was a nightmare for a syndicate manager because it meant you had highly levered retail owning more than your shoe. And this is going to be the first time that there's potential for that in US IPOs. So that's a first to watch, yet another first for this deal. But at the same time, this is not just US retail, right? You've got stock being placed with Japanese retail, Australian retail, European retail, and those are very different animals. So, I mean, I don't know how to handicap that stuff.
Yeah. So, and here in the UK, they've used what's called the POPS. So it's fascinating case study. They have 2 billion placed in the UK, and there's no prospectus. I mean, so consistent. That's been approved by any UK regulator. I don't know how quickly, in many cases, retail can flip because some platforms penalize you for flipping early. Some platforms, you don't get your stock in time, as well. Or, are they going to pick up the phone? Are they going to execute your order? It's not that easy. And also, I think U.S. retail, though that does have margin and can buy things at margin and leverage, it's not quite the same as Hong Kong. It just doesn't have the same sort of, in Hong Kong, if the stock doesn't open up 30%, everyone's running for the hills and selling. And as soon as it goes from 30% up to 15% up, you can forget it. You know it's going to break issue price that day because everyone's going to be dumping the stock. It's not that febrile. But look, it's going to be a very exciting first day. I'm looking forward to watching it. I think it's a landmark deal. It may get ugly. It may be fine. I think as well, what the other thing to mention is the outcome of this deal will drive what happens on the next two, on Anthropic and OpenAI.
Yeah, that's what I was just going to ask you. I mean, when you think about you have $3 trillion companies coming public. I mean, both of you guys been in the game for a while, or had been in the game for a while. I mean, how wild is it that, you think about the .com, we had like 1,000 little fires, but they were crazy. Now we have all those in one, basically, or in three. You know what I mean? Like, so the idea of raising 300 billion or 250 billion in 3 deals is basically the exact opposite at these valuations, right?
Yeah, I mean, look, so this is the .com era kind of on steroids in some ways, right? Because, or even the SPAC era on steroids. You had a lot of deals coming. Some of them were very difficult to explain, but they would perform extremely well initially. But the scale of this, the scope of this is beyond any of our imagination. It's intergalactic almost. So, but to be very fair, Elon Musk has defied the critics. Tesla has performed amazingly well. And people have been saying it's overpriced now for 7-8 years. Everybody who went into the Twitter deal, they were underwater for a while, but in the end, they made money. So people are prepared to give him, at least financially, the benefit of the doubt, and that faith is going to be tested. Not just today. It's going to be tested over the next year.
Yeah, and I was saying, go ahead, Rupert.
No, you go.
Yeah, I mean, I was saying, I was a guest on a podcast earlier, and we were talking, and like, Elon is kind of like a black hole for capital. He attracts capital, and I like to say we're at the height of faith-based investing, and no one gets more faith without rational thinking than this guy, right? And maybe he deserves it, maybe he doesn't, but like, this guy gets the benefit of the doubt more than anybody we've ever seen. Is that a fair statement?
Well, what would you say about crypto? I mean, crypto still doesn't have a use case, and yet there are billions or trillions in cryptocurrencies. And I still don't use any of these to buy anything, to sell anything. And in some ways, these stocks are a little bit like a meme coin, or it's just a sort of a reflection of enthusiasm. I mean, how much value is in Hawk Tua coin? I don't know.
Not much anymore.
Not much anymore. But at one time there was. And what were people thinking, right?
Well, I think that's fair. That's right. That we get in these securities, whether they're stocks or crypto or whatever, where they go money in and people just chase. But I think let me ask you guys this, because I know you guys were equity capital markets dealers. One thing that's going on now is we have the credit markets involved again. We have a lot of credit pointing into these data centers, right? And we had credit in the .com, and we had credit in the GFC, and we had credit in the shale boom. And so when you guys start thinking about that, we see Google do an $80 billion raise, biggest raise ever. Maybe tomorrow will be the biggest raise, but for 1 week it was. What do you guys think about that, Craig? What do you think about Google coming out and putting $80 billion of paper in the market right in front of the biggest IPO ever?
Well, again, is that a signal that credit is actually tightening and they're finding it more difficult, or are they just saying our stock price is so hot that the cost of capital for our equity is low? We might as well just de-risk a little bit and create a bit more headroom for us to keep going. Because bear in mind, when your stock gets so high, okay, it's actually sensible to start issuing shares like crazy because your cost of capital is really low. I don't know which it could. By the way, those two interpretations are not mutually exclusive either.
Correct.
And there are a lot of I've read a lot in the press about that the era of de-equitization is over. In other words, we've benefited from pulling back of supply of equity in the market, and now it's coming back. Look, I think the big winners, of course, will be the equity capital markets bankers, and Rupert and I have clearly retired too early. That's my big takeaway.
I give Rupert a hard time about that. He left a couple sticks on the table there.
Well, listen, I have to say I don't miss it much, and I don't think I'd want to be sitting in Goldman or Morgan Stanley's equity capital markets desk for the next 24 hours. I think it's going to be hairy times, not least because they've got a whole calendar on the line. And so that was going to be my next question for you, Craig, was what is the baseline that SpaceX needs to achieve to not call into question the next two up in the form of the rest of your three amigos of AI?
I can't tell you all. It's 12.2% higher.
No. Broad brush, impressionistic.
I think broad brush, if it stays a margin above the IPO price and it looks pretty solid and pretty stable, I think then it's open for the other guys. The question is if it's flat or down, the other guys will probably have to quite conspicuously offer a discount to the numbers that probably they've been floating around. So I think it's more a question of just how much of a discount that they're going to have to provide. There's also the question of Anthropic versus OpenAI, because their financial performance, at least optically, looks very different. Now I've seen arguments saying that Anthropic's performance has been flattered by some one-offs and so forth. And we'll have to actually look at the filings to see if there is a difference between the two. But I think if it trades, this trades down, I don't know if it shuts the market, but they're going to have to slash their valuation by quite a substantial amount, so people feel that it's going to be a no-brainer to invest in the Anthropic or OpenAI IPO. If it's trading up 10, 15% or whatever, then I think it's all systems go.
Yeah, well, both deals will be the other side of next week's first meeting for Warsh. And as credit availability and liquidity generally, is playing a huge part to play in the whole enterprise AI story. Once again, he's smart to have got out ahead of that. This is yet another nasty ingredient that's being contributed to Kevin Warsh's first sort of 6 months as Fed chair, right?
Yeah,
there's a lot of hungry mouths in the Hunger Games, isn't there?
Look, we all can see the signs of excess. Okay, so let's not kid ourselves. Whether in the credit market or in the equity market, the investments in AI, and there are going to be a lot of there's going to be a lot of losses to nurse and bear. But the question is where those losses are going to be incurred and when. And I know, Rupert, you've argued that this deal could be the one that breaks the market. And you may be right. But it's just so hard to predict when it comes off the rails, and it's very difficult for any fund manager to get off the carousel. And so many people have a stake in this deal. This deal is almost the equity capital markets equivalent of too big to fail. Almost every bank is in this deal. Almost every large investor is already in the cap table. So that's why you have an almost kind of North Korean unanimity within the syndicate, within the analyst community.
It does feel like that. It feels like, hey, the Squirrel and I have talked about this on the 2 podcasts and the 2 reports we did on it. It was like, hey, look, everybody who's anybody's gotten a look. And maybe that's actually a good question, Craig. in 2011, I had started my own operation, and one of the things that we saw was that there was an opportunity to be getting secondary shares because there was the merger possibility. I saw the tech thing coming, and then the employee stock. And so back then, we didn't have this whole like we come late. I mean, they were complaining about the Facebook IPO. If you guys remember that, they're like, "Oh, it's been private for 8 years, right?" Well, SpaceX been private for 25 years, right? Like, so we're talking about like a company that's a quarter century old almost. And what do you think that dynamic is, where a lot of sophisticated, sovereign wealth funds and family offices already had the look, or maybe they're already there, versus this was their first time to get it?
Look, that's a great point. I mean, the markets have changed over the last 25 years, right? I mean, the IPO market is no longer the primary venue for growth investing. It's the primary venue for exit liquidity and benchmarking. And no, I mean, look, that is an important purpose, but it's a different purpose and maybe a
Yeah.
less romantic purpose than, the fairy tale that we've been told about the IPO market. And companies have been going public later and later, and this is just a continuation and an acceleration of the trend we've already seen, just as it's also going to be a continuation and acceleration of the trend in favor of large caps. Because who cares about a small cap anymore when you have these behemoths coming to the market? So I don't disagree with any of that. You know, it's almost as if the public markets are kind of a continuation of the private markets, and this is just another event on the road, and that this company has already been traded or been held for a very long time. Admittedly, I don't know about 25 years, because yes, the company was founded 25 years ago, but in its kind of current iteration, especially with the AI,
That's fair. That's fair.
it's relatively young. It's just that the valuation they've slapped on it is quite fulsome, even at the outset. It's incurring a lot of losses, but it doesn't, it's not leaving much. There's a lot of execution risk in achieving that value and justifying that valuation.
Well,
But
it was $40 in December, right? So we're talking about a triple since December. And if you look at Starlink, the ARPU is down. I'm a Starlink customer, so just for fair warning. But like, I don't see, when I look at the numbers, they don't strike me as it got materially better. So that's where we come out at, is like, is this just a money grab, if you will?
Well, a lot of people have been saying that, and certainly, there are some pretty good arguments for that. I think around $1 trillion plus of the evaluation in this is centered on AI, and then you look at 85% of the tab they have in their perspectives is enterprise AI applications, and they cite an organization. I wrote about this. They cite an organization that none of us ever heard of, which was founded in the Middle East by a few countries.
Yeah, this was their Forrester research. Was this one man's shop in Riyadh that gave them their enterprise AI TAM?
Yeah, I don't know if it's a one-man shop, but it's not an organization I'm familiar with, and it's been founded. It was founded by 4 or 5 different countries in the Middle East. Not exactly a credible source, but I guess they had to find what they could. But arguing over the fundamentals is almost beside the point. It's like, as I said, it's like a crypto coin. It's whether you believe that he can generate value, that by sheer force of personality, by his political nous, by his ability to marshal other stakeholders in society to support him, whether it means getting subsidies, whether it means getting the index people behind it, whatever it is, he has shown an ability to get other people to create value for him. And if you think he can do that trick at scale, then you're going to be a believer in this. If you think that this is just so mind-bogglingly expensive, then you won't. But that's really what this is about. It's not about whether SpaceX have projected their ARPU is going down to $66 or from where around 100. They've already projected that, although they've also been guiding towards subscriber growth. It's not about that. It's about whether you think he can marshal the rest of the world to support this venture.
Yeah, absolutely. For me, the physics has always outweighed the fundamentals on this deal by a mile, right? And the question is, can he tick off that list of superlatives of never having been done before in global capital markets? I mean, I'm riveted by this. And Craig, I promise to get you out of here before 8 o'clock so you can get to your breakfast. Benny, any last thing you want to ask Craig?
I guess the last thing I'd ask is, this deal, you have Elon with 85% of the voting rights after this. When you guys were running deals, would you get pushback when guys were trying to do the Class C shares or this kind of nonsense? Like, was that something? Or are we at the point where they, guys, it is what it is? I mean, back in the day, would that be kind of thing people would push back against?
People care about governance when markets are tough. When people want in, they don't care. They couldn't care less. And look, whatever it is, this is Elon Musk's company. Elon Musk is the key person on this transaction. And I think that although some of the funds, the Danish pension fund, the New York City pension fund have expressed concern, understandably, about the lack of governance here. I think for most investors, if you don't want to buy into Elon Musk, if you don't want to give him that control, there's no point in coming into this in the first place. I think they just take that kind of view.
Great.
Perfect. Well, we have we have 6 hours left to run before we get the instance of a sort of a first whisper price. Going to be watching with fascination. Craig, thank you so much. Everyone, please follow Craig. He's quite good on the LinkedIn, but make sure that you follow his articles on Alphaville because they're free and they're a ton of fun. And thank you once again, Craig, for getting up early. And thank you, Benny, for not going to bed so late. Go and get some sleep. Go and get some coffee. I shall go and get this out onto the interwebs as quickly as possible. Thanks very much indeed.
Thanks, guys. Thanks, guys.